Sometimes I like to analyze other investor strategies. Recently, I looked into Warren Buffett's history of investments. Regardless of what you think about him, he's one of the greatest investors of all time, maybe even the greatest. While Warren Buffett was managing and building Berkshire Hathaway, the conglomerate grew at an annual rate of nearly 20% from 1965 to 2024, whereas the S&P 500 grew at average annual rate of 10.4% during the same period of time, which is extremely impressive. But how can you replicate at least some of his success, and what you should focus on when picking stocks? That's exactly what I'll be diving into in this video as we break down some of the key lessons from Warren Buffett's investing strategy. So how he picks stocks? When people talk about Warren Buffett, they often look for one magic number like PE ratio, but that's not how it works. Buffett don't just use one metric, he looks at many things together and always want to deeply understand the business that he's buying. But the most important things for him are return on equity, which is ROA. It basically shows how much profit a company makes from the owner's money. Buffett likes companies with ROA above 15%. That means the company is very good at using shareholders' money to make more money, but it will be slightly different for each sector. For technology, it will be around 30%, but for sectors that are heavily capital intensive, it will be much lower at around 10%. The next thing he's looking at, and not less important, is ROAC, which stands for return on invested capital. It basically shows how well company used all its money, both the owner's money and borrowed money. Buffett wants strong and stable ROAC, usually above 10 to 15%. It means that company has real competitive advantage. But at the same time, he avoids companies with too much borrowing. He prefers companies that use very little debt. Too much debt can be dangerous when the economy gets bad. The fourth thing, but not less important, is APS, which stands for earnings per share. That indicates how much profit company makes from each share of stock. Buffett likes companies that grow their APS steadily for many years, not just 1 or 2 good years, but decades. Fifth thing that indicates good company is free cash flow. It's basically real cash company has left after paying all their taxes and expenses. Buffett loves business that produce a lot of extra cash. This money can be used to grow the company or return it to shareholders by dividends. And at top of everything I said before, there are not less important metric, the profit margins. The profit margins show how much profit the company keeps from every dollar of sale. He only wants high and stable margins. That means the company can charge good prices without losing customers, often because of their strong brand. Like, for example, like Coca-Cola, which is one of his biggest positions in portfolio. He owns around 400 million shares in Coca-Cola, which is extremely big position. Another thing is price to earning ratio, which is PE. PE ratio tells you how expensive stock is compared to the company's profits. Buffett looks at PE, but never alone. He does not just buy the cheapest stock. He wants to buy great companies at fair price. Sometimes he even accepts higher PE for excellent business if he believes that they have potential to grow. And the most important thing from all of these metrics that I said before for him is economic mode. Economic mode is basically when it's like special long-term advantage that protects the company from competitors. By using the example from his own portfolio, we get the Coca-Cola, which is very strong brand known worldwide. They have very low cost of production and strong network that others can't easily copy. Another example is a situation in which company has extensive infrastructure focused on its core operation, such as power plants or mining operation. Such assets are often extremely costly and difficult to replicate, which create significant barriers to entry and can function as an economic mode, limiting the ability of potential competitors to enter the market. However, companies of this type often face other risks, such as heavy regulations. By simplifying all the things I said, Buffett does not want to buy cheap companies. He looks to buy only great companies at reasonable price. He also looks for strong business with good and steady profits, low debt, a clear competitive advance, which is economic mode, and predictable future,